a better place filled with the peace and love. Thank you.
Wonderful.
Yeah.
Thank you. And now, let's see. Do we have any visiting Rotarians? I'm not seeing any. Did I miss anybody? Okay. Guests, we welcome Bruce Hoffman earlier. Bruce will be giving us the Merchant Minute in a moment. And we have our two speakers from the Capital Group. Ed Gonzalez, it's great to see you again. Welcome.
Thank you. Hello, how are you?
Very well, thank you. These are strange times here, as you know.
They are.
Strange times everywhere, but we're still grateful to be healthy and functioning. And Jay, welcome to you again.
Thank you. Thank you.
I invited, and I'm not seeing him, but I can't see the whole screen. I also invited David Ford from the Capital Group to join us. David, as you probably know, is the vice president and wholesaler. I deal with him a lot. He's a great guy, and I thought he would enjoy hearing you two speak. So it may be that he's just been delayed. He's not sitting in the waiting room, so that much we know. Anyway, welcome. It's great to have you all with us. And
Thank you.
we have a few announcements. First, August birthdays. Is Phil here? We discovered that Phil Gabriel really was born in August. His birthday shows up differently, but on Club Runner. But we'll say happy birthday next week to Phil and also to Gwen Leister. Jim Crane's birthday will close out the month. So happy birthday to all of you. I want to mention the Beirut Relief Fund that has been set up by District 5280 in partnership with the LA Cedars Rotary Club. Went into action really quickly to provide food, shelter, medical aid, debris cleaning, reconstruction for the victims of this terrible disaster. And best of all is a mechanism that gives you confidence about how the money is going to be handled. Donations are being sent directly to Rotary clubs in London who are providing on-the-ground aid and ensuring that the funds go to those who need them the most. In the upper left-hand corner is a picture of the LA City Hall, which had a graphic projected supporting the victims in Beirut. So if anybody wants to mail a check, the information is above, but you can also just go to the District 5280 website, which has other means of making donations, electronic donations, for example. So I wanted to be sure to bring this up. It's a great example of the capacity that Rotary has to go into action very quickly in the case of catastrophe. And we want to wish Music Men's Minds a very happy, fantastic 6th anniversary. And CNN Heroes recently filmed Music Men's Minds in action with Anderson Cooper narrating their story through an international Zoom session. Is Carol still here?
Yes, I am.
Oh, great, because like I said, I can't see the whole screen.
Yeah,
but,
no, I'm thrilled that you're sharing with the club.
Yes, and I also just want to tell you how thrilled we are and impressed by the incredible work that you and your organization have done on behalf of these very important causes. So it's very exciting. I just wish I had thought to include this last week before the screening or before the Zoom session. Do you know whether recording will be made available?
CNN now has an hour-and-a-half interview of me personally.
Oh, wow.
Plus an hour-and-a-half footage, raw footage of the Zoom session.
Wonderful.
And we will have a completed story in about a month or two that will go with their outreach.
Great. Well, if you would somehow include me and us on the distribution list, we'll make sure to get that dispersed.
Thank you so much.
Oh,
Thank
my
you
pleasure.
all of you.
Thank you.
Thank
Gordon, I
Nancy?
see your hand raised.
Yeah, on the Beirut thing, has our board considered making a contribution
We
from
will,
the club?
we will talk about that.
Nancy, can I
Yes.
interrupt for just a second?
Sure.
John O'Keefe just called me and he's having trouble connecting online. So you better be ready to make the introductions today.
Okay, I am actually.
Okay, and he's supposed to take the minutes. I'll brief him, but are you recording this?
Yes.
Okay, he can do it from that then.
Yes, it is recording. I started it right on time.
Yeah.
So thank you. Thank you. And next
Nancy?
we have, okay. Next we have,
Nancy,
No,
Oh,
he's
hi,
on,
John.
John's on.
welcome. Great. We'll
I'm
be with
in
you.
now. I'm in now, but I can't get in to see me, but I can get in to talk. Can you hear me?
Yes. Yes, that's great. I'll let you know when it's time for you to make the introductions. How's that?
Okay, good. Thank you.
Great. Thank you. Marcia Hunt. Is Marcia with us? I know she had planned to. Marcia, I wanted to be sure to let you know, and some of you may have seen her email announcement, that she is being interviewed on a program called Together for Peace tomorrow at 2 p.m. our time. She and I both have the Zoom information, and here's Phil. And as we all know, Marcia has done remarkable work in Uganda that led to her receiving an honorary doctorate from the university. So it should be a fascinating interview if you are able to join her. And before we go further, we have an addition to our agenda. I will now turn you over to Mark. Let me see if I can find you, because I have to, again, Mark, I have to make you the host, and then you can make me the host when it's time. Mark is going to introduce our Merchant Minute. Over to you, Mark.
Okay, if you could make me the host and I can screen share. Rotarians, this week's Merchant Minute. This week's Merchant Minute is a friend of mine, play golf. We know each other at Hillcrest. We've done business together. And his operations now are headquartered in Culver City, but they're working out of his partner's home office in Westwood Hills. And I'd like to introduce Bruce Hoffman from Metropolitan Property Services. And Bruce, go ahead. You got 5 minutes.
Okay, thank you again for the invite. I really appreciate it. Metropolitan Property Services is a residential property management company. We manage 3 typical product lines: apartments, HOAs, homeowner associations, and single-family homes. The allocation of those product lines is approximately 25 single-family homes, 35 apartments, and 75 homeowners associations. Our buildings are basically located in the West LA general area, from Santa Monica, Westwood, Palisades, Culver City, Beverly Hills, Hollywood, Mid-Cities, and a few in Sherman Oaks and Encino. Our company consists of 22 employees, and the employees consist of property managers. We have a full service maintenance department that consists of 8 people, accounting and administration. The question that everybody's interested in is, how has COVID affected our business? And we were very worried about how it would affect our business. And fortunately, it hasn't affected it much. I mean, we're an essential business, so we keep the doors open. I'd say 2/3 of our employees work at home. We kind of were setting them up for that even before COVID, to where employees can work at home with IT, proper IT and software. So that was an easy transition for us. collecting rents on the multifamily, and the single family was a concern. And we have steadily been in the low 90% of collecting rents, which means 7-8% of people had asked for relief or had asked for special arrangements, which if you're reading the news and you're seeing what's going on, we comply without any problem. We can't even ask why. We can't ask, are you working? What's the problem? We just have to comply. But they also realize that they have to pay it back. And, you know, it seems like there's a moving target on the timeline. So it's still in process of what's going on. If you're curious, our average rental in our portfolio is about $1,600 to $1,800 a month for apartments. So I think that also bodes well for a lot of our tenants are paying rent. It's, you know, it's more of a blue collar type of occupancy, but we've been very fortunate and very pleased, and our owners are very pleased with the fact that we're getting 92-93% rent. On the single family homes, the average rent is about $9,000 a month, and that ranges anywhere from $5,000 to $20,000 a month in rent, depending on how big the house is and where it's located. So again, our employees are grateful to be working. Everybody's taking precautions with masks. Tenants are signing indemnifications when we go to their units for maintenance needs. And we're being very prudent and sensitive. If employees don't feel comfortable working, they don't have to. One of the trends we are seeing, which is interesting, is a lot of turnover, or not a lot, but more turnover than usual. And we can only attribute it to the fact that, you know, families are consolidating. And I think a lot of people also are looking to get out of Los Angeles. That being said, we don't have too much of a problem re-renting. So it's a little sluggish, and we're maintaining the rents we've been getting and increasing a little bit as well. So that's the only thing we could think of as far as the turnover. And through some of the exit interviews we have, it seems to be the same thing. They're moving in with their sister, they're moving out of LA, and so forth. The other thing we've noticed with COVID is a lot more tenant disputes within. Everybody's getting on each other's nerves. You know, it's cabin fever. And a lot of tenants are complaining that, you know, so-and-so is not doing this, or so-and-so is doing this. And that has really blown up. And that has been a concern to us. Eviction is very difficult, if impossible. So typically what we do is we become referees, sometimes marriage counselors, psychologists, and we do the best we can to try and solve internal issues within a building. But when necessary, we have attorneys on standby as well that can threaten with eviction depending on what the issues are. So that is my presentation. I'm happy to answer any questions.
I have a quick question. I don't know how active you are in the North Village. What's your impression on what percentage of those apartments in the North Village are people going to come back and rent? I know some people are locked into a year lease, but a lot of people aren't coming back. What do you have any idea what the percentage of North Village is going to be occupied?
I really don't. We don't track those type of trends. So I'm sorry, I don't know.
Okay, any other questions? Thank you, Bruce. Thank you for joining us. And Mark, thank you for arranging for Bruce to speak to us. So, let me see, let me get my screen back, sorry. I would like now momentarily to turn things over to John O'Keefe, who will introduce our guest. And let's see. Here we go. So we'll introduce our guest, but since we don't get to look at John, I'm going to say something about John that I've often been tempted to say. And that is that, you know, we've all heard it said at times about a person that when they smile, they beam. To me, that's John O'Keefe. John has one of the warmest and brightest smiles I've ever seen. So picture that now while I turn the audio over to John, who will then turn the program over to our guests. And oh, by the way, I'm sorry, let me interrupt you for 1 second. Jay and Ed, I just want to check with you. Do you have a presentation that you want to share with us?
Nancy, I'll be able to, I can share my screen. So
Okay,
yes.
great. So here's what we'll do, because my system makes me make you the host, which is fine. So after John, in fact, right now, I'm going to make you the host, Ed, and then when you're finished speaking, if you would just make me the host again, then we'll just pick up and go from there. So let me just find
Nancy?
you on my.
And Nancy?
Yes.
Nancy, Jay Barnes is going to start the presentation for Capital Group, and he's going to introduce Ed. So,
Okay, that's
so
fine.
maybe Jay Barnes should be the host.
Well, only the host, the person who's the host is the person who needs to be able to do the screen sharing.
Okay, I guess that would be Ed. That would be Ed Gonzalez, yeah. Okay. I'm ready when you're ready for me.
You see us, Ed. Okay. I'm going to hope that I'm turning this over to the right person, because we have an Ed too. So I will make you the host, Ed. I'm going to make the person who's listed on the screen as Ed. And
That's
then,
me. ED.
yes. Can you
I'm now
see?
the host. Yep,
Great.
I'm now the host.
Okay, John, over to you.
Okay. I'm glad you can't see me because my face is kind of red now. Not from sunburn either. But anyway, can you all hear me?
Yeah. Loud and clear. Yep.
Okay. Okay. I'm going to say a little bit about the Capital Group at first. The Capital Group is a American investment management company headquartered in Los Angeles with over get this now, 2 trillion that is, a trillion's 1,000 billion, 2 trillion in assets under management. It was founded in Los Angeles in 1931 at the bottom of the Depression. It is privately held and has offices around the world in American City, in the Americas, in Asia, in Australia, in Europe, and it employs about 7,500 people. It's with great pleasure that I'm going to introduce Jay Barnes now, who's a Senior Vice President and Private Wealth Advisor for the Capital Group Client Services. He works with high net worth individuals and families and with nonprofit foundations and endowments. Prior to Capital, he worked as head of research sales at Bear Stearns and with the institutional team at Sanford Bernstein. For full disclosure, my wife Patty and I use the Capital Group, and Jay is our client service person. He does an outstanding job helping us understand these volatile markets and even holding our hands from time to time. So Jay, you're on now, and we look forward to hearing you.
John, thank you for that lovely introduction. You're a hard act to follow, so I'm not going to mount a vigorous defense. I'm going to be very privileged to turn the presentation over to my colleague, Ed Gonzalez. Ed is an investment specialist at Capital Group Private Client Services. And in that role, Ed is highly integrated with the investors at Capital Group. So he's visiting virtually these days the companies that the investors are visiting. He's part of the discussion internally about how investment decisions are made. So Ed can bring to life a lot of the funds that we manage on behalf of clients. And he's going to take us through a landscape that he's helped create in terms of the presentation. Without further ado, I'll turn it over to Ed. Thank you, Ed.
Thank you very much. And let me share my screen. Let's see. Okay. You are hopefully now all looking at something that says markets and economy become disconnected. Can you all see
Yes.
that?
Yes.
Outstanding. And for anyone who's following along at home, we're just on the very, very first page, and I'll be calling out page numbers if for those of you on the phone that are just looking at your computers. Okay, so there have been a lot of questions lately about what is going on with the markets. We see that the economy is having all sorts of issues. We're seeing worrying numbers. We're seeing GDP going down. There's the COVID-19 is still out there, and yet the markets remain resilient. Have the markets lost their mind? Are they completely divorced from reality? And that is the question that we are going to answer in this presentation. So as we can see here, while the unemployment rates have spiked up and come down a little bit, and while the markets have gone down, they have made a fairly aggressive and impressive rebound since their bottoms at the end of March. In addition to that, not only the stock market returns have been good, US, global, international, the emerging markets in Q2, but also fixed income has made fairly impressive returns in Q2, and US Treasuries certainly have done quite well year to date. Most all fixed income, with the exception of high yield, has done well year to date. So what's going on? Now, I'm going to take you through really 3 specific things today, and I'm going to keep an eye on the time here. I've got a stopwatch going. Number 1, I'm going to break it down sector by sector and industry by industry, and we're going to figure out, are truly the markets completely disconnected from reality, or is there some sort of method and logic to the madness that seems to be going on in the stock market? Number 2, we're going to talk about the government response, everything that's going on with the Federal Reserve, Congress and their fiscal response, as well as potential vaccines and therapies. And finally, number 3, we are going to be talking about the active role that we are taking as portfolio managers, companies that we like, industries that we like, and things that we are doing within the portfolio that has led to some fairly, and I'm going to brag for our portfolio managers for a second, some really stupendous outperformance over the last year. So without further ado, let's jump into the markets. Okay, so we have seen the MSCI World and the S&P 500 make a pretty impressive rebound since the bottoms that we saw at the end of March. But what's really going on? Well, what we're seeing is actually a tale of 3 cities. We are seeing certain industries that are absolutely doing stupendously well. We are seeing certain industries that are struggling a bit. And then we are seeing another section of industries that are really, really down because of everything that's going on. So let's first just take a look sector by sector. So I don't think this should be a huge surprise to people, but information technology, all the tech companies are doing really, really well. We're all working from home. We are relying on technology more and more. Many people are ordering groceries for the first time, are buying more things online, streaming videos more. We are connected through computers at the moment. So information technology companies are doing quite well. Also, hopefully not surprisingly, healthcare companies. We are going to become very, very reliant on seeing our doctors, on antivirals, on general medication. They are also doing well. Now, consumer discretionary is an interesting one because consumer discretionary, while it is positive, if you take a look over here, only 23% of the companies within consumer discretionary are positive year to date. Most of them are down, but what's in consumer discretionary? Well, I don't know how many of you know this. Amazon is not considered information technology. Amazon is considered consumer discretionary. So Amazon is literally pulling up an entire sector into the positive realm. Now, we have many that are struggling, but really down here at the bottom, I'll just focus on these 2. Financials, these are the big banks, are really struggling because interest rates are at historic lows. And with all the action that the Federal Reserve is doing to include increasing its balance sheet by over $3 trillion since the beginning of the year, is keeping interest rates incredibly low, as well as the energy sector, because of a lot of different things, has been really beaten up. People driving less. There was a price war going on between Russia and Saudi Arabia, and that was also one of the very few industries that we saw trouble in moving into 2020 before COVID even began. So my big question to everyone is it complete madness that information technology and healthcare are doing well, that Amazon.com is doing well, that many other industries are struggling, and some, like banks and energy, are really, really down in the dumps. So our answer to that is that this isn't surprising. There does seem to be some method to this, method to the madness. It's just when people aggregate it all together and look at the market as a whole, they're surprised. But when you break it down sector by sector, it does seem to make sense. The one big thing that we would add to that is that people have become very, very complacent over the last 10 years with thinking they can just stick everything in an index fund and forget about it. You know, we as an active management shop have been warning about that for a while, as others. You really, in this environment, really need to understand the companies, really need to understand the sectors. And if you don't, you can get yourself into trouble. And I'll get into some of our numbers over the last year as well. So the other big thing is that markets in general try to anticipate what the economy is going to do next. So if we saw a market bottom at the end of March, in general, if we go by all the past recessions going back to 1950, market bottoms as well as economic bottoms, markets try to anticipate what the economy is going to do. I call it 4 to 5 months. So we saw a bottom at the end of March, April, May, June, July, August. So what markets are anticipating is that we should be seeing a bottom somewhere right around now, and the economy is going to not recover, but try to recover. Now, economic activity actually started to pick up really in May and early June. We're seeing these numbers here. So the market was responding to, and certain companies were certainly responding to the increase in economic activity. Now, are we back to where we were at the end of 2019? Absolutely not. And it's gonna be a while to get there, and we'll talk about that in a second. But we're starting to see a trend upward. Now, could there be a wrench thrown into this? Yes, we'll talk about that. If all of a sudden there is a huge resurgence in September and October and mass restrictions need to come back down again, that could potentially throw a wrench into this. But right now, what we're seeing is an economy trying to recover. So let me pause here because I've been speaking for 6 minutes and I'm going to keep myself on a tight time horizon. I want to open it up right now. We've talked about the stock market and the different sectors. I'm going to be moving on to the government response, Federal Reserve, and Congress next. But let me pause and just push it out to everyone who's listening. Any questions about what's going on in the market so far up until this point?
Yeah, I've got a question.
Yeah, please.
With the new Biden proposed tax increases, and especially with regard to capital gains and estate taxes, will you address this later on in your conversation? If a Democrat is elected and we do have a Democratic Congress, what effect that could have on the stock market with the tax increases that are scheduled on his proposal, and also on what it would have on capital gains as well.
Yeah,
Thank you.
that's a great question. I'll touch on a little bit right now, but also I've got a chart later on that'll give us some historical context. I would say that, you know, my big message is that we're not having, let's pretend for a second that the Democrats are going to win. We're not going to be having a Bernie Sanders or that type of, you know, that philosophy entering the White House. I think that Joe Biden is much more of an institutional Democrat. And I think a lot of people were really terrified that when President Obama took over, that the stock market was going to suffer dramatically by the things that he was talking about and crash. And they really missed a huge uptick and growth in the stock market. So am I hugely worried about the overall stock market? No. There are some finer points when it comes to individual taxes, but we could probably spend an hour talking about that. And actually Capital Group has a whole separate topic just on that and tax planning. But that would take me over an hour to get through. So I'll pause there and move on, but I'll have a chart later on, Chris, showing you Republican versus Democrat and stock market returns.
Can you enlarge the chart, please, so it's
Yes.
easier to read? Thank you.
Let me see. Tell me if that's any, hold on. Is that any better?
Yes.
Yes, yes, thank you.
Great, perfect. Okay, let me Any other questions before I move, before I push forward on what's gone on with the stock market to date? I'm going to be getting into government actions next. Okay, point 2. Let's talk about what the government's up to, because I think that has certainly affected the markets and will flow through to the economy. Okay, just over here on the left, first we have the fiscal response. This is the actual response coming from Congress. Now, just to put it in perspective, this is massive, massive fiscal response by Congress. Could potentially get even bigger as we move into 2021, or if there's problems later on in the fall. And just to put it in context, in 2008, the fiscal response represented about 1% of GDP. We are currently at 10% of GDP, with potential more to come. So Congress really has taken off the gloves. The other portion of this is the Federal Reserve. The Federal Reserve has increased its balance sheet by $3 trillion since the beginning of the year. They also have unused capacity of over $2 trillion. They now have separate funds and areas to help out municipalities if they get into trouble. And you know what we like to say here is that I don't think they're going to potentially be using everything. They have already used a huge amount by expending their balance sheet. But the idea is that if you show up to a street fight carrying a bazooka, you probably won't have to use it. What the Federal Reserve is trying to signal to the economy, to economic participants, and to the world is that the gloves are off, and they will do whatever it takes to make sure that there is short-term liquidity in the system, and that if there's another spike with COVID-19 that forces people to stay home and there's a short-term cash crunch, they will be there to fill that void. And they are really going to do whatever it takes. Now, we can certainly debate politically and economically the pros and cons of that, but Congress and the Federal Reserve has signaled both. The gloves are off, and if something bad happens, they will flood the system with money and liquidity if necessary. So what is that actually doing to the real economy? Well, I track it quite a bit, and first let me mention the Purchasing Managers Index when it comes to manufacturing. This is Warren Buffett's favorite index that he likes to track because it focuses just on manufacturing. He feels, and there's a good argument here, that it's really tracking the true economy and what's going to be happening over the long term. What we see here is that China's, and so anything above 50 is considered expanding and growth. 50 is considered stable, and anything below 50 is contracting. And so these numbers were as of June 30th, but as of August 1st or July 31st, China is positive, US is positive, and Europe is positive. So while we had a huge downturn in March and April, started the climb up in May, we're breaking even in June, and now we are all in positive territory for the manufacturing sector. Retail sales are also struggling. They are certainly not back to where they were, but what we are seeing is a move upward. The other big chart that I track that isn't on here is what a lot of economists track. It's the Conference Board's leading economic index. These are the 10 indicators that most economists follow. Those are also positive in both the US and China, and slightly negative in Europe. So in general, we're seeing economies in the US and China that are trying their best to recover. Europe, the data is a little bit more mixed, but especially in the manufacturing sector, I think we're seeing the Eurozone, the Euro area trying its best to recover. And I think one of the best ways to think about this is that, and I'm stealing this from someone, this isn't mine, but I like it. It's almost thinking, almost don't think of this, what we're in right now, as a recession. Think of it as the Great Suppression. The economic downturn is a direct result of government actions and of individuals suppressing economic activity by choice. We are doing that to save lives, certainly a good thing. But as soon as we see those restrictions lifted, what we are seeing in the numbers is an economy trying really hard to rebound. So the fundamentals seem to be there, and that once we figure out how we want to deal with this virus and the restrictions are lifted, the numbers seem to indicate that the economy will recover. It may take a while, but the numbers are moving up. Finally, well, maybe not finally, here we go. Just looking at weekly unemployment claims, we are seeing here that while they are certainly on the trend downward, they're certainly much higher than they were in February of 2020. The other thing that we're watching is consumer confidence. While it is on an uptick from the bottom, consumers are still worried. They're worried about their jobs. Therefore, they are not spending as much. They are saving a lot more money and just tentative to see what happens, especially come the fall. So what are we looking at here? And let me check my time because I think I'm running a bit over. Okay. What does that actually mean for a potential recovery? Well, there are three really likely scenarios that we're taking a look at. We are taking a look at a V-shaped recovery where we hit the bottom, we just shoot right back up. We do not think that that's likely. A W-shaped recovery is we're starting upward, but the fall ends up being truly horrific and terrible. We have to do a huge lockdown and the economy tests lows again, which is, we're going to call that a W, so it starts to go up and it goes back down. What we see more likely is something like a U or even more of a square root, where we are going to have while we are recovering, it's going to take a while to get back to where we were at the end of 2019, beginning of 2020, because while we're figuring out how to deal with the virus, it's really going to take a long time to get fully back to where we were, figuring out how kids are going to go to school, how work environments are going to change, and get our economic activity back to where it was. So I anticipate a recovery, but a slow recovery with a lot of volatility mixed in. I'm going a little bit over on my time here, so I'm going to throw through this feed. This has to do with a vaccine, and I just like to share these numbers with you because what we are hearing on the news seems to be very, very optimistic. And while we all want to be optimistic, and we would love it if there was a vaccine that everyone could start taking in, June of 2021, I just want to show you some numbers. As far as vaccines for different viruses, the HIV vaccine, we're 35 years and counting to try to find one. Influenza took 28 years to find a vaccine. Chickenpox, 28 years to find a vaccine. COVID, their goal is to have a vaccine sometime between 12 and 18 months. And when you look at the history of how long it takes to develop a true working vaccine, we are trying to temper our optimism. The one thing that we will say is that as opposed to a vaccine that will prevent you from getting sick, we are seeing already huge strides forwards with medicines that you do take once you are sick. So Gilead, one of the companies that we own, we've owned them for a long time, has remdesivir, and that is the drug, the antiviral, that is showing the most promise and has seemed to work the most when it comes to helping patients that have it. And the other one is, and I may mispronounce this, dexamethasone, which is also done by Gilead, which is also showing a lot of promise in reducing the time they stay in the hospital and certainly reducing mortality rates. So our view moving forward is that while it may take time to get a vaccine, antivirals are doing quite well. They are making, every month they seem to be refining the mixture and getting it better and better. So our expectation is that if someone does get COVID-19, say over the course of the next 6 to 12 months, hopefully we'll be there, there'll be medicine, potentially even a pill that they can take that will reduce symptoms. They will have to go to bed. They will feel miserable for a week or two. It will not be fun, but they won't have to go into the hospital and be put on a ventilator. So that is our more short-term optimistic thinking, while we are a little bit hesitant to think that a vaccine will be coming in the next 12 months. So let me pause there. I've covered a lot. I talked about Congress stimulus. I talked about the Federal Reserve, and I've gotten into vaccines. The next section is going to be the actual moves that we're making in our portfolios and how we are reacting to everything going on. But let me check in with everyone and see, are there any questions about government actions to date, whether it's Congress, Federal Reserve, or things that you've heard about vaccines or antivirals that you'd like me to discuss a little bit more?
I have a quick question. What you think with Congress and Trump not extending the unemployment $600 a week, you think more people will be forced to go back into the workforce? Because I know I couldn't hire anybody who was on unemployment because they were making way more money than I could possibly pay them. and it was just, they could sit at home, make more money than going to work. You think that'll force people to go back into the workforce?
I certainly think it will. The other thing that we've seen in the numbers is that when restrictions are lifted, even if people are accepting unemployment, people seem to be eager to get back to work, because I think they were viewing that unemployment as certainly something short term, and they didn't want to see that their job being put at risk. So at least when we look at the numbers in aggregate, that certain sectors are different. When we look at the numbers in aggregate, what we're seeing is that people seem to want to get back to work once the restrictions are lifted. So yes, I do think it's going to encourage people to get back to work, even more so than they are already. Philip, I hopefully answered your question.
If I could ask a question about the bonds that the Federal Reserve has purchased.
Yes.
Do we have any information back about those bonds yet in terms of their solvency or their rating, possible rating changes since they purchased it to prop up the market?
Yeah, so are you talking about the fallen angel bonds?
Yes.
Okay. I think the Federal Reserve did what its intent was, which was so for those of you who don't know, we have investment grade bonds and we have high yield, some people refer to them as junk bonds. Right at the lowest level of investment grade bonds, we have BBB bonds. And BBBs are just one step above high yield. So what happened during this economic crisis and during the Great Suppression is that because economic activity became crunched, a lot of these BBB bonds that were considered investment grade were downgraded. And when they go from investment grade to high yield, they are called fallen angels. And when the Federal Reserve started initially buying up bonds to push liquidity into the system, they only were doing it for investment grade bonds, and they were not touching high yield bonds. Well, they made an adjustment to say, okay, we are going to step in, and as long as they were BBB beforehand and they become fallen angels, we will then loan them money. So will there be some companies that probably go out of business anyway? Yes, but it certainly has seemed to work. A lot of those fallen angels have been able to get the liquidity they need, and it has stabilized the market. But I think it was Dwight that asked this question. The real question here, and unfortunately I don't have a good answer to this, is, how long is this going to take? The Federal Reserve's thinking was this is hopefully going to be a short-term thing, and this is just a short-term cash crunch. These companies were good and investment grade before this economic suppression, so they should be good afterwards. Hopefully everything's going to recover within the next 3 to 6 months and there won't be problems. If this ends up going on for a year, year and a half, there certainly could be solvency problems. I don't have an exact answer for you, but that's what's going on. But the intent behind what the Federal Reserve did is that it did prop up those fallen angels, and they've done quite well as a whole. Okay, any other questions before I move on to the actions that we're taking within the portfolios, the markets? Okay.
Doesn't look like it.
Okay, perfect. All right. So let's go in. So I mentioned this before, and that is that we are active managers, and we definitely have we've signaled warnings before about just putting all of your money just in an index fund and forgetting about it, because people have stopped looking at fundamentals, or too many people have stopped looking at fundamentals, and that can be an issue. And that's certainly, our strategy has certainly paid off handsomely over the past year, where a lot of our strategies in global, the MSCI Global World, we've outperformed by about 1,000 basis points over the last year. In the small cap strategy, by 2,000 basis points, or 20%. So let's just talk about some of the things that we've seen so far and tweaks that we're making right now. So just for fun, just by a show of hands, who wants to go to either emergency room or a doctor's office right now, sit in that doctor's office for an hour or so with a bunch of sick people just waiting around to be seen by a doctor? Does that sound like a great idea to anyone? Yeah, no. To me, it sounds like a terrible idea. So one of the things that has been hugely growing is telehealth, and we'll get into that in a second. We've been investing in companies that is a trend that has been growing for a while, and it's really just expanded. Supply chains. There has been a huge focus over the past probably 20 years, this move towards what's called just-in-time inventory, where you only have exactly what you need in your factories to ship out, and it's just being manufactured as you need. This pandemic has shown that that strategy leaves a lot of companies exposed to certain events like this. So we expect to see a diversification of supply chains and companies holding more inventory, which as far as commercial real estate goes, and we'll get into that in a second, potentially is going to have a need for more warehouse space within the United States and in other places. So let's just jump in for a second to some of these charts. Okay, let's talk about, and I'm going to be checking my notes here, e-commerce. So some questions that we are asked is, hey, look, people have been buying online. That's great and all, but has this trend run its course, and have we peaked already? And is that space not going to grow anymore? Our answer to that is we're not even getting warmed up. As of 2020, online purchases still represent just less than 12% of total retail sales. So until we're getting to 50% online and 50% in store, I think this still has a huge amount of room to grow. Amazon is still just half the size of Walmart. Walmart is even trying to now expand and is working very, very hard on Walmart.com, making sure there's more online purchases. So we think that this area has certainly a long way to go. We've been investing in Amazon. There's also the cloud with Amazon, Microsoft as well. There's other companies that are also really going to be benefiting from this. And these are the, we'll call it the picks and shovels companies of the technology industry, people who are supplying parts. So think of Taiwan Semiconductors. We've owned ASML, which also manufactures semiconductors. That's a Dutch company, as well as KLA. On top of that, when we're thinking about real estate, get a lot of questions on real estate. Is commercial real estate going to completely die? Our answer to that is no. There's certainly potentially going to be a lot of office space moving forward that may not need to be used. However, and I touched on this a little before, you have to expand and think about total commercial real estate space. So at the end of 2019, I was a featured speaker at the Anderson Forecast event at UCLA. And one of the trends that we saw was that Amazon, Walmart, and Target were all in bidding wars in Southern California, around the country, to get warehouse space that was either cold storage or could be converted to cold storage easily. Why? Same day grocery delivery. That was going to be the big push moving into 2020. They really want to start going after grocery stores. This idea that you can go on your phone or computer first thing in the morning, put in your grocery order, and then by that afternoon it's delivered. That trend was firmly in place before COVID-19. COVID-19 has simply accelerated that trend dramatically. So we can see it. We'll certainly see a lot more warehouses and cold storage warehouses being bought up. On top of that, because there is so much in the e-commerce space, and we talk about streaming, there's also a need for these big warehouses that just hold servers. So one of the best companies that we've owned over the past year is a REIT named Equinix, if I'm pronouncing that correctly. And again, it's just a REIT that is dealing with these big warehouses that hold servers. So in the commercial real estate space, again, it's all about understanding exactly the kinds of commercial real estate, where they are in the market, and how it's going to be expanded. I mentioned global streaming. I mean, I don't know how many movies you all have watched. I feel like I have watched all of Netflix since this began, and people are just spending more and more time streaming as well as playing video games. Okay, let's talk about healthcare. One of our greatest sectors that we overweighted that led to our outperformance was our overweight in healthcare moving into 2020. We saw it as a great space beforehand, and it has been really a fantastic investment throughout this process. So these are interesting numbers. So global antiviral medicines were expected to grow 5% annually before COVID-19. These are still the numbers that we have. We don't even know how huge this number is yet, but we have so many companies that are focusing on antivirals right now to deal with COVID-19. We have, I think, over 200 in development and being tested right now. As I've mentioned before, Gilead is leading the way right now with remdesivir and dexamethasone. There's also Roche and AstraZeneca that we both own that are also developing antivirals and pushing them out there to the market. When we talk about global telemedicine, two big companies that we owned beforehand and that we have added to throughout this, United Healthcare, which we have added to, and Anthem. Why? This was a trend that we've actually been following for quite a while. We wanted to see what healthcare companies were going to be able to reduce costs and deliver healthcare and medicine efficiently. Telemedicine was going to be a huge part of that, just by making the delivery and talking to your doctor or nurse more efficient, less costly. And so we were actively investing in companies that were investing in telemedicine. That has certainly been huge throughout this crisis. And we believe it is going to continue to be a trend moving forward, not just because it's going to prevent you from going out and sitting in a room full of sick people. It's just a more efficient way to deliver healthcare. So that has been a trend we have liked and followed for a while. Finally, I mentioned some bad sectors. And that doesn't mean that all companies within those struggling sectors are bad long-term investments. So here I like to share things that are not going well, but to show you what we're doing. Within the sectors that are struggling, it is about liquidity, liquidity, liquidity. Who is going to be able to ride out the storm, survive, get to the other side, and because they have survived, they will grow their market share and soak up more of the market on the other end. So when we take a look at the big energy companies and oil companies, we are taking a look at net debt to earnings, who has really strong balance sheet, who has cash on hand, and who could potentially buy up small companies that go out of business during this crisis. Best one that we like the most and that we've added to is Chevron. The other one that we like is Total in Europe. These are the two companies that we've been investing and adding to during this crisis. Finally, cruises. Certainly no one is taking cruises right now. No one's even thinking about taking cruises right now. However, it is something that we do believe will return in due course, and Royal Caribbean seems to have the most cash on hand. So I am at my time right now. So I wanted to check in with all of you and see if there's any questions on what we're doing in our portfolios before I pass it back to Nancy.
I've got a quick question.
Yes.
What do you think about fixed income from investments like 8% or 6% on investments that concentrate on like hotels or senior centers where they kind of rely on having a high occupancy rate? What do you think about those type of investments right now?
Right now, we're staying very far away from them. We actually completely, we love hotels maybe in the long term, but we got out of those pretty quickly, right in the beginning, just taking a look at where everything was headed. So not something that we're interested in right now, but the portfolio managers, as they decide and as they see opportunities, they may decide to make some decisions like they did with Royal Caribbean here, but that is something that we're staying away from at the moment.
What are your stocks in telemedicines?
I'm sorry, say that again?
What are your stocks in telemedicines?
Biggest ones, United Health and Anthem are the ones that have been for years investing a ton of money in that. So those are the two ones that we've been focused on, and we've added to United throughout this crisis, and we've stayed firm on Anthem. Haven't added to it, but we hold decent sized positions in both moving in.
This is Chris. Ed, I'd like to ask you just a follow-up question. We've seen some incredible appreciation in stocks like Apple and Amazon, and especially Tesla.
Yep.
And when do people start taking profits? It seems to me and I'm a Democrat, and to see these proposals by the Biden group, it just sort of jumps out to me that people are going to start taking profits at the end of this year, and that could be accelerated and bring the market way down if, in fact, he does get the nomination. Have you and your group discussed the possibilities?
Absolutely. It's something we discuss all the time, and certainly before Biden was nominated, because it has more to do with the stock market being highly concentrated. And I've actually got something. Here we go. Top 5 stocks, currently about 22% as of June. Microsoft, Apple, Amazon, Alphabet, Facebook. You know, the other time it was this high was in 1999. So concentrations in these top stocks that we're focused on. So gets into a bit of a story, but our philosophy and our portfolio manager, whenever they see these high concentration, a few stocks, they start saying things called picks and shovels, picks and shovels. That is a reference to the gold rush, meaning that the people who got the richest in the gold west weren't the actual gold miners, it was the people selling them picks and shovels.
Correct.
So when they see companies like Amazon, Microsoft, Apple that they like, that are good companies, but are becoming a little rich and think that there may be a pullback and people start taking profits, they start looking at their suppliers. So I've already mentioned a few of them, but Taiwan Semiconductors, ASML, KLA, what companies that maybe aren't as richly priced, but are going to benefit from Amazon, Apple, Google doing incredibly well, but that maybe the market hasn't caught on to yet. So picks and shovels, picks and shovels. And the other one that I wanted to highlight is, look, Democrat or Republican, forgetting your individual tax rates, the stock market tends to grow, the economy grows regardless of who is in office. This is a chart that goes all the way back to 1933 at the bottom of the Great Depression. The stock market moves up. Now, not to say that you as an individual might not have to, have conversations with your accountant, and we have separate presentations for that to look at exactly what's going on with the tax rates, but that would take another hour to go through, and a lot of it's speculation at this point because we don't know who the president's going to be.
Thank you, Ed. This was a great presentation and
Very
really
good, Ed.
worked well. Okay, I'll tell you what, we only have about a minute and a half left, and I see we have a couple of questions. So we generally end right at 1:30. If you're willing, Ed, to stay on with us for a few more minutes. Anybody?
Absolutely.
Yeah, thank you. Anybody who needs to go, please feel free to go ahead. Bye, Allie. and we'll take a little more time for those who would still like to ask questions. Thank you.
Nancy, so we'll see you at 5 o'clock?
Yes.
Okay.
Where did Dwight go?
Hi, Kathy.
Oh, okay. Any other questions? I don't want to keep you waiting if he's not here.
Yeah.
Well, again, thank you so
Ed?
much.
Yes.
Ed, yeah, John O'Keefe, I'm not on the video thing here, but I just wanted to ask a little bit about foreign companies vis-a-vis U.S. companies, emerging market companies. What do you think about those compared to our U.S. companies?
Well, it's interesting. We try, so when people think about US companies versus international companies, in our view, they focus too much on where that company is domiciled and not where their revenue is coming from. So one of the things that our analysts really focus on is, where is this company getting its revenue from? So let me see, just hypothetically, L'Oreal. L'Oreal is based in France. France may be struggling as an economy. However, if you look at all of its revenue, they have a huge amount of revenue coming from the United States, from Canada, from Australia, but it's one of its hugest source of revenue has actually been online sales in China and other emerging markets. And they have really been doing incredibly well. So when you look at the actual growth of the revenue there, most of that's coming from online sales in the emerging markets. So I would say that we are looking at, because Europe is struggling a little bit right now, we want to look at companies that have really diverse revenue streams and are in areas that they can gain revenue where the economies are growing. So while Asia is certainly struggling, certainly a great place to gain revenue, as well as, probably the United States is a better place right now than Europe is, of course. Hopefully that answered your question.
Ed, could I ask?
Thank you.
Yep.
Do you or your firm have a view with respect to whether we are facing inflationary pressure versus moderate to deflationary pressure over the next 2 to 3 years?
Yeah, great question. Okay, so two-part answer to that. Short term and then the more medium 2 to 3 year term. Okay, so short term, we do not see any inflationary pressure. Why? Because COVID-19 and the suppression by government actions is causing a lowering of economic activity, which puts downward pressure on prices, which by definition is deflationary. The $3 trillion expansion of the Federal Reserve balance sheet, as well as the huge effort by Congress, is there to prop up economic growth. So at least for the short term, that is actually going to be helpful to the US dollar because it's promoting growth. That's short term. Now, over the intermediate term, it's a slightly different analysis. The two things that we look at are where is inflation right now? I'm sorry, not inflation. Where is expected GDP, long-term GDP right now for the United States? And that is sitting about 2.5% above inflation. And we have the Federal Reserve targeting inflation of about 2%. So call it 4.5% nominal GDP growth over the long term. We look at the 10-year Treasury, and that is currently sitting as of today below 70 basis points. So the US government can borrow at incredibly low rates, and the economy will grow more than it is borrowing. So at least over the medium term, we also do not see inflationary pressures. Now the big question is, can this go on forever? Of course not. Absolutely not, it cannot. But the two things that we need to be watching for is the inflation, and then what happens to the 10-year, 20-year, 30-year, what does it take the government to actually borrow? As those numbers creep up, what we'll want to see is the Federal Reserve and Congress starting to back off. If they don't, that's when we could potentially see really bad inflationary pressures. But none of the data right now is indicating that we're headed towards either near or intermediate term inflation.
That's a great and thoughtful answer, Ed. And I'd like to ask a follow-up.
Please.
And that is, what is your firm's feeling in connection with the potential for negative interest rates?
Great question. I've actually studied this quite a bit. So there's a lot of good data on this because a lot of the European countries have been experimenting with negative interest rates. Yeah. And what we see is that when your interest rate is positive, as it moves towards zero, that seems to help and promote liquidity into the system. When it goes negative, that actually puts so much stress on financial institutions like banks and other lenders that actually stifles economic growth, and it gives you exactly the opposite of what you want. So when the Federal Reserve in March, in the end of March, really moved to rates pushing them towards zero, they very publicly came out and said, look, the Federal Reserve can only do so much. We're doing what we can, but Congress needs to have a fiscal response. So at least in the US, we do not anticipate negative interest rates. What we anticipate is that rates pretty much close to zero, with Congress adding fiscal response on top of that. Because the data coming out of Europe basically says that negative interest rates don't do what we want them to do, and they don't help.
Thank you, Ed, and great presentation.
Yeah, absolutely.
I agree, totally agree. Any more questions?
Thank you very much, guys.
Thank you, everyone. We really appreciated the opportunity.
My pleasure. Anytime. Nancy, it's great seeing you.
Great seeing you too. And I wanted to say, Ed and Jay, thank you both so much for joining us, and again for an excellent presentation. In gratitude, we will be making donations in both your names to the Westwood branch of the Los Angeles Public Library.
Thank you.
Thank you.
And I hope to get to see you again soon.
Yes, when all this is over.
Okay, everybody, have a great afternoon. Thank you for being here.
Thank you. Bye-bye.
Bye. And